SCHD has one of the most loyal followings of any ETF in existence, but most people who own it have never seen it measured against the full range of alternatives with real return data. We ran the numbers across 10 ETFs, and the results are not what most people expect. Before we get into the numbers, one thing needs to be clear about how this backtest works. We are not trying to convince you SCHD is the best ETF available. We are running the data honestly and letting the results land wherever they land, because some of these findings genuinely surprised us, and they should be part of how any SCHD investor thinks about their portfolio going forward. SCHD, the Schwab US Dividend Equity ETF, launched in October 2011. That gives us approximately 13 years of return history through the end of 2024, which covers multiple bull markets, the 2022 bear market, a pandemic crash and full recovery, and the AI-driven technology rally that reshaped the market landscape in the early 2020s. For ETFs that launched before 2011, we use the same 13-year window starting at SCHD's inception date. For ETFs that launched after 2011, we used their available inception-to-date data and clearly noted the shorter comparison window wherever it applies. All return figures represent total return, including dividend reinvestment, which is the only figure that tells the complete story of what an investment actually delivered. To make this comparison genuinely useful, we selected 10 ETFs covering the full range of strategies a dividend investor or index investor might be choosing between when evaluating SCHD. The lineup is VOO, the Vanguard S, and P500 ETF at 0.03% expense ratio representing pure large-cap index investing. VTI, the Vanguard Total Stock Market ETF at 0.03% representing the entire U.S. equity market. QQQ, the Invesco NASDAQ 100 ETF at 0.20% representing high-growth technology-heavy investing. VUG, the Vanguard Growth ETF at 0.04% representing large-cap growth stocks. VIG, the Vanguard Dividend Appreciation ETF at 0.06% representing dividend growth without a yield filter. VYM, the Vanguard High Dividend Yield ETF at 0.06% representing the high yield dividend approach. DDY, the iShares Select Dividend ETF at 0.38% representing high dividend income with quality screens. DGRO, the iShares Core Dividend Growth ETF at 0.08%, which targets dividend growers using a different methodology than SCHD. And JEPI, the JP Morgan Equity Premium Income ETF at 0.35%, representing the covered call income strategy. SCHD itself is the 10th fund at 0.06% expense ratio. This is SCHD against the full landscape of strategies most investors are actively choosing between. Here's the full ranking on annualized total return from October 2011 through the end of 2024, based on data consistent with Morningstar and Portfolio Visualizer historical records. All figures include dividend reinvestment. QQQ delivered approximately 18.5% annualized. VOO delivered approximately 16.5% annualized. VOO delivered approximately 13.5% annualized. VTI delivered approximately 13% annualized. VIG delivered approximately 12.5% annualized. SCHD delivered approximately 12.5% annualized. DGRO delivered approximately 12% annualized over its available window since its 2014 inception. VYM delivered approximately 10.5% annualized. DVY delivered approximately 9.5% annualized. And JEPI delivered approximately 8% annualized over its available window since its May 2020 inception, a notably shorter comparison period than the others. On a $10,000 initial investment held through the full period, those return rates produce the following ending balances. QQQ turns $10,000 into approximately $95,000. VOG turns $10,000 into approximately $73,000. VOO turns $10,000 into approximately $52,000. VTI turns $10,000 into approximately $49,000. VIG and SCHD both turn $10,000 into approximately $47,000. VYM turns $10,000 into approximately $36,000. DVY turns $10,000 into approximately $32,000. JEPI, on its shorter 4-year window, turns $10,000 into approximately $14,000 from its 2020 inception through the end of 2024. The single most striking number in this entire backtest is the gap between QQQ and everything else. UQQ's $95,000 ending balance is roughly double what VOO produced and double what SCHD produced from the same starting investment over the same period. Every $10,000 put into QQQ in October 2011 grew to approximately $95,000 by end of 2024. Every $10,000 put into SCHD in the same month grew to approximately $47,000. That is a $48,000 difference from a single $10,000 starting point. The reason is not complicated. The NASDAQ 100 over this period was powered almost entirely by the dominance of a small group of technology mega-cap companies including Apple, Microsoft, Nvidia, Meta, and Amazon. These companies grew their earnings, expanded their margins, and generated capital returns at a rate that no quality screen dividend portfolio was designed to replicate. QQQ does not pay meaningful dividends. It does not filter for financial quality or dividend history. It simply owns the largest non-financial companies on the NASDAQ and rides whatever they produce. For the 13 years ending in 2024, what they produced was extraordinary. Growth investors who chose QQQ over SCHD made the financially correct decision on total return based on this historical data. Here's where the data becomes directly useful for anyone currently choosing between dividend ETF options. Within the dividend category, SCHD is not just competitive. It wins on both total return and income growth simultaneously, and the margins are meaningful. VYM, which holds approximately 550 high dividend yield companies and is frequently cited as SCHD's closest competitor in the dividend space, produced only $36,000 on a $10,000 investment versus SCHD's $47,000. That $11,000 gap means a 30% better outcome for SCHD investors over the same period. VYM does not apply SCHD's quality filters around free cash flow and return on equity, and 13 years of data shows that omission costs investors real money. DVY, which has been running since 2003 and uses iShares high-yield methodology with its own quality screens, produced only $32,000 on the same investment. That is $15,000 less than SCHD over the same period. DVY has historically concentrated in utility and financial sector companies with high current yields, and that sector tilt did not keep pace with SCHD's broader quality-driven approach. DGRO, which many investors view as SCHD's most direct methodological competitor, came in at approximately 12% annualized since its 2014 inception, placing it slightly behind SCHD on total return but well ahead of VYM and DVY. The difference between SCHD and DGRO is smaller than most comparisons suggest, which means investors choosing between them are making a more nuanced decision than the headline yield difference implies. The finding that arguably changes how most SCHD investors should frame their position is the gap between VOO and SCHD. VOO produced approximately $52,000. SCHD produced approximately $47,000. The difference on a $10,000 starting investment over 13 years is approximately $5,000. That gap is real and should not be minimized, but it is dramatically smaller than the narrative around growth versus dividend investing typically implies. The reason the gap is smaller than expected is SCHD's behavior during market downturns. SCHD declined approximately 11% during the 2022 bear market versus approximately 19% for VOO. That capital preservation partially offset the return gap during bull market phases, which is why the long-run difference between the two funds is $5,000 rather than the $15,000 to $20,000 gap most people assume when they hear that the S&P 500 outperforms dividend ETFs. JEPI cannot be fairly compared over 13 years because it launched in May 2020, giving it only 4 years of data in this backtest. Its approximately 8% annualized total return over that window looks significantly weaker than SCHD, VOO, and every other fund in the comparison. What is critical to understand is that JEPI launched just before the COVID recovery rally, which was one of the sharpest and most sustained bull market periods in modern history. JEPI's option writing strategy deliberately caps upside participation in exactly that type of fast-rising market, which is why it lagged so dramatically from 2020 through 2024. Comparing JEPI to SCHD on total return over 4 years is not a fair representation of what JEPI is designed to do. It is, however, accurate data that any JEPI investor deserves to see. Total return is one dimension of this comparison, but for investors who need growing income from their portfolio without selling shares, the second layer changes the conclusion significantly. SCHD currently yields approximately 3.7% annually and has grown its dividend at approximately 10 to 12% per year since inception, according to Schwab's historical distribution records. An investor who bought SCHD at its 2011 inception at an initial yield of roughly 3% now has a yield on cost of approximately 10.5% on the original invested amount. Every $10,000 put into SCHD in 2011 is now generating over $1,000 per year in dividend income without selling a single share. VOO generates approximately 1.3% yield currently. QQQ generates approximately 0.6%. An investor drawing income from those funds to cover living expenses must sell shares to supplement the minimal distributions, which introduces sequence of returns risk during market downturns that SCHD investors do not face in the same way. The same $10,000 initial investment in SCHD is producing 7 times more annual cash income than VOO and 17 times more than QQQ from the same starting capital without any asset liquidation required. If this backtest gave you a clearer picture of how SCHD actually compares against the full range of alternatives, subscribe, because every week we run the actual data on the funds that millions of investors hold without ever seeing numbers like these.